Unlock financial freedom, master velocity, banking, and accelerate your path to debt-free living and wealth accumulation. Hello and welcome back to No Money. Are you intrigued by the idea of paying off your debts faster and saving money on interest? If so, you've come to the right place. In this comprehensive video, we're going to dive deep into the world of velocity banking, a financial strategy that has the potential to help you pay off your mortgages and other debts swiftly while reducing your interest payments. Whether you're new to velocity banking or have some knowledge already, this video will equip you with a thorough understanding of the strategy and essential considerations you should keep in mind. Understanding velocity banking. To fully grasp velocity banking, let's start with the basics. Velocity banking, at its core, is a financial strategy designed to help individuals pay off their debts, particularly mortgages, more rapidly while simultaneously minimizing interest costs. It operates on a simple yet powerful principle. By utilizing a line of credit, you can strategically manage your debt payments to your advantage. In essence, velocity banking is about leveraging financial tools to your benefit. Instead of making standard monthly payments, you actively utilize a line of credit, such as a home equity line of credit, HELOC, to reduce the principal balance of your primary debt, whether it's a mortgage, student loan, or other significant financial obligation. The critical concept here is that traditional debt payments primarily cover interest in the initial years, with only a fraction going toward the principal. Velocity banking aims to change this equation by focusing on rapidly reducing the principal balance. By doing so, you not only shorten the repayment timeline, but also reduce the total interest paid over the life of the loan. It's a strategic approach to managing debt that requires discipline, planning, and a clear understanding of how it works. Example of velocity banking. Let's take a closer look at a practical example to understand velocity banking in action. Meet Chris, who currently has a 30-year fixed-rate mortgage of $300,000 with an interest rate of 4%. Additionally, Chris possesses a home equity line of credit, HELOC, with a balance of $50,000, carrying an interest rate of 5%. In a traditional mortgage scenario, the interest paid is calculated based on the outstanding balance each month. Initially, Chris owes the full $300,000, and his interest payment is determined accordingly. However, with each monthly installment, a portion of that payment is allocated to reduce the principal amount. Consequently, as Chris continues to make payments, the interest portion gradually diminishes. On the flip side, HELOC interest functions differently. It's computed based on the average daily balance over the course of a month. So when Chris employs his HELOC to make an additional payment of $500 towards his mortgage principal, it has a twofold effect. First, it reduces the HELOC balance, which in turn lowers the average daily balance used to calculate interest. Second, it accelerates the payment of the mortgage principal, which is where the real magic of velocity banking happens. Now you might wonder, why opt for a HELOC instead of simply making an extra $500 payment directly to the mortgage? The answer lies in the overall strategy. Without velocity banking, Chris's regular monthly mortgage payment stands at around $1,432. However, when Chris adopts the velocity banking approach, his monthly payment increases to $1,932. This initial rise in the monthly payment might appear counterintuitive, but it's a strategic move with far-reaching benefits that go beyond the surface. The impact of velocity banking. Now that we've delved into the mechanics of velocity banking, it's time to explore the tangible impact it can have on your financial situation. By incorporating this strategy into your debt management plan, you can potentially experience significant benefits. The primary advantage of velocity banking is the potential for substantial interest savings. Let's return to our example with Chris, who, without velocity banking, would pay approximately $215,000 in interest over a 30-year mortgage term. However, when Chris implements velocity banking by making an additional $500 monthly payment through his HELOC, he can significantly reduce this figure. In fact, his total interest charges drop to around $136,000. This means Chris saves a staggering $79,000 in interest payments alone. Furthermore, the time frame for debt repayment is dramatically shortened. Chris, with Velocity Banking, pays off his mortgage in just 20 years instead of the originally planned 30. This not only relieves him from the burden of mortgage payments sooner, but also frees up his financial resources for other life goals. It's crucial to emphasize that Velocity Banking isn't just about paying more each month. It's about strategically allocating your payments to maximize their impact. By focusing on reducing the principal balance faster, you not only save money on interest, but also build equity in your property at an accelerated rate. While the initial monthly payment might seem higher, the long-term financial benefits are undeniable. Velocity Banking empowers you to take control of your financial destiny by paying off debts more rapidly and ultimately achieving your financial goals sooner. However, as we'll explore in the next section, it's essential to be aware of the potential risks and considerations associated with this strategy before diving in. Risks and considerations. While Velocity Banking presents a promising path to financial freedom, it's essential to navigate this strategy with caution, recognizing that each person's financial circumstances are unique. Here are key considerations and potential drawbacks to bear in mind. Firstly, and most importantly, Velocity Banking involves using your home as collateral when you employ a HELOC. This means that if you cannot meet your HELOC payments, you risk foreclosure on your property. Discipline and commitment to sticking to your budget are non-negotiable. Without careful management, the very asset you're leveraging to expedite debt payoff could be in jeopardy. Secondly, HELOCs typically come with variable interest rates. Unlike fixed-rate mortgages, HELOC interest rates can fluctuate over time, subject to market conditions. If interest rates rise, your monthly HELOC payment can increase as well. This fluctuation may reduce the effectiveness of your Velocity Banking strategy and impact your overall financial stability. It's essential to assess your risk tolerance and have a plan in place to manage potential interest rate fluctuations. Lastly, Velocity Banking may not be the ideal strategy for everyone. If you're already on track to pay off your mortgage within a reasonable time frame and have a low interest rate, Velocity Banking might not provide significant advantages. In such cases, you should consider the opportunity cost of allocating extra funds toward mortgage payoff. Instead, investing those funds in opportunities with higher returns, such as the stock market or retirement accounts, could potentially yield more substantial long-term gains. Velocity Banking is a powerful financial strategy with the potential to accelerate your debt payoff and save you substantial money on interest charges. However, it comes with risks and considerations that need careful evaluation. Remember, every financial situation is unique, and what works for one person may not work for another. Consult with a financial expert to determine if Velocity Banking aligns with your goals and circumstances. If you found this video informative and helpful, please don't forget to like and subscribe to No Money. We regularly share insights on various financial and self-improvement topics. Thank you for watching, and we look forward to seeing you in our next video.